Top Report, welcome back to The Lens with Craig Shapiro and Larry McDonald. Since 2010, we host an institutional live chat on Bloomberg with more than 660 investors in more than 23 countries. If you're interested in joining us, please email Tatiana at thevertopsreport.com. Thank you and enjoy the video.
Okay, we ready to go? All right, we're live. Thank you everyone for joining us. We're back at the Friday Lens. We've got a special guest today, the doctor, Robert Van Battenberg is in the house. Rob, you've been incredibly valuable to us in the creation of our new book, How to Listen When Markets Speak. I just want to tell everyone, once again, we run the institutional chat on Discord and on Bloomberg this week. We gather the intelligence. It's a lens on a buy-side conversation. And what we do with this show every week on Fridays, we want to recap kind of the most important things that are happening that you need to know about. I think most importantly, Rob, through my career over the years, going through the 80s, 90s, 2010s up to now with Lehman, there are rare times when the rate of change of information on the earnings area of companies is so fast that the street is kind of like is going to have to catch up. Rob, if you look at just FedEx today, the transports are making new lows, but at the end of the day, the rate of change, Delta Airlines and United taking up numbers in January and then down in March. And all these companies that took up data and up their CFOs have to be, I think, a lot more accountable in terms of rate of change on information than Wall Street strategists. They have to move faster. They have shareholders, and if things change in the data that they're seeing, they have to change their opinions. So it's what I've noticed, Rob, and I want you to go through the kind of list, but there's a lot of companies that took up guidance in the fourth quarter and now they're taking it down in a very short period of time, the rate of change. Can you go through what you're seeing? So you've been talking to the institutional clients this week. What are people saying about this?
Yeah, so we saw about 2 weeks ago, we saw the first airlines, Delta, American Airlines, Southwest, United Airlines warning about the abrupt slowdown in air travel. Uh, JetBlue was one of those as well. That was quickly followed up by some of the very weak and not so weak retailers. Kohl's was one of them. Dick's Sporting Goods is a good retailer, but they too gave out a warning call. And Puma, which is a sneaker maker back out in Germany, they came with a Verizon, right? They were talking about the postpaid softness, which postpaid, those are the expensive contracts. Those are the iPhones. Of course, people are very price sensitive to that as well. And then we've had some industrials. CSX was reporting, that's a railroad. And then, as we move along, there were a few other airlines, ALGT, that warned earlier this week. And then we had last night, we had Nike, we had FedEx, we had Lennar, right? All giving out yeah, FedEx missed, Nike had good numbers, but they had soft guidance. Lennar had decent numbers, but they were very cautious, right? The home building environment is not very good. We saw some very, very ominous signs coming from Florida, where prices are coming down really quickly now. And as we know, Florida leads the U.S. market in terms of the housing market. So that's ugly as well.
Now, Rob, think about this. Wall Street strategists, and the equity strategists, they go to the same squash country clubs. They play squash on the Saturday mornings. It's a cabal. Now, CFOs across 20, maybe 30 companies have drastically taken down numbers in the last 2 weeks. At the same time, you've got the street earnings estimates for this year are still up at $270. So that means, think about that. So 5,600 on the S&P and $270, that's like 21-ish times. But if the rate of change that we're seeing from the CFOs, if that number is really 250, 240, $230 in reality because of the rate of change, and the street has to adjust to that rate of change that we're seeing from corporate America, then we might be trading at 23 times earnings now.
Right. Yes. And you have much less earnings growth, right? Remember, earnings growth in the fourth quarter was 14%, was the highest in rate since I think 2020, the middle of 2023. So there was some very healthy earnings growth in the fourth quarter.
Well, that's
And
the thing,
now
Rob.
suddenly
Yeah, Rob.
people are starting to quickly. And remember, this is something that is obviously related to the tariff threat. And that only started at the end of January, right? So that has been working its way through the economy now for the last 1.5 months. But yeah, so airlines were one of the first to get, to feel the effect. But a lot of companies still have to, one of the most amazing charts is the sentiment chart. It's basically an aggregator of all the news, thousands and thousands of news sources in the United States that are talking about uncertainty. And right now, that uncertainty measure is higher than it was during the great financial crisis or 9/11. So people are scared, they're terrified, and they're paring back on their consumer spending. And
but the street's still up at $270 for earnings for this year. So in other words, the street was, what happens with street analysts is it's a cabal. And like I said, they hide out in packs. And when the rate of change of information is steady and slow, it's a very safe place to be in that cabal. But when the rate of change of information speeds up, either positive or negative, they have to adjust. So literally 35, 40 days ago, they were in the animal spirits growth camp. And now, as you've been showing our clients over the last couple of months, the interest on the debt, the terming out of the debt from Becent, bringing on kind of a slowdown, again, interest rates, that you made that bond call. So Rob, when we did a trade alert on TLT in January, around January 10th. Anybody that wants to get on the trade alert, reach out to Tatiana at thebeartrapsreport.com. But Rob, when you came out with that high conviction alert on the TLT to get long bonds, and everybody was bearish bonds, it was the most bearish sentiment in years, right? In terms of CFTC data, everybody was short bonds. What were you seeing, and what are you seeing to make people, want to buy bonds?
Yeah, well, one thing is that, and you discussed this as well, it's like when you have this cabal that really were drinking the Kool-Aid about animal spirits, they really thought about the growth acceleration in the US economy, and it was in part driven by the Trump election, but it was also driven by Biden's spending. Like everything the Congress had made available to him in the last 2 quarters of his term. He was shoving money out the door as if there was no tomorrow. Spending year over year is up deficit spending is up like $300 billion in the first 5 months of the year. So that has driven GDP numbers, and that has driven growth expectations higher. And then when you're coming into the new year, when Trump is taking the wheel, he had to pare back on that spending.
What were you seeing to get people? What are the bonds? What were you seeing to give you your signal to buy bonds in January?
Well, so there was that, the cutback in government spending. You had the debt ceiling, right? When the debt ceiling goes into effect, you don't have any net issuance of debt anymore. So we've had in the fourth quarter $1 trillion of additional issuance in the debt, but that is all evaporated, right? So there's no net issuance of debt right now until they raise that ceiling. And
so when did they hit the debt ceiling?
That was the third week of January.
Okay, so then they can't issue any more net new debt since then. But
so
then what clients are talking about in the chat, Rob, is once they can raise that debt ceiling later on in the year, then all of a sudden we're going to have to catch up on debt issuing bonds. Isn't that what Ray Dalio's getting at? Later in the year, we have to issue a tremendous
Yeah, but
amount
we
of
don't
bonds.
know how much later in the year that is. And Bessent is a very smart guy. He's probably finding ways to get additional demand for treasuries before that wall of treasuries is starting to hit the market. For example, changing the supplemental leverage ratio that allows banks to take on more treasuries. I think I lost you, Larry.
I'm
Sorry.
here.
Okay. So yeah, like changing some of the regulation that allows, for example, banks to buy more treasuries. There are other ways too where you can increase treasury demand. But so we're under the debt ceiling now. Government had to pare back spending. Then you got Doge, right? According to the Doge website, Doge.org, they've found already $100 billion of money that they've saved. So there's that. And so there were multiple factors that we saw. And then, of course, you had the tariffs, right? The tariffs, everybody was ignoring them in the beginning of January. They thought, that's just a negotiating tactic. It's a negotiating tactic. You listen to Trump on the campaign trail. It's every time he was talking about tariffs.
Yeah, I get you. So now we have animal spirits, growth. Now it's, oh, maybe these tariffs are real, but we're still up. Once again, let's get back. We're still up at $270 for S&P earnings this year. That's basically where we were in January. You know what I mean? So we've had a big rate of change in what the CFOs are telling us across 30 companies. And this is a chart of I guess, earnings misses or guidance lower. So we've got this violent rate of change, but the street's still up at $270. So if that comes down to say 240, 230, and the S&P 500's at 5,600, we might be trading at 23 times earnings now. I think that's what is going on with the market, because we're having a very difficult time bouncing off of key. I mean, we should be bouncing under the 200-day. That's where we should be bouncing.
Right. Yeah, there's another thing, right? And we discussed this before. I believe, and I think there's more people that are starting to realize this now, that one of Trump's strategies in order to get 10-year yields lower, to get the inflation cooling, is to hit the market with a bunch of tape bombs. Tape bombs to essentially sap all the momentum out of the market. And if we now realize that most of the discretionary spending in the United States is taking place by the top 10%, and they're also the ones that own all the stocks, if you basically sap the momentum out of the market, you could also drive down some of the spending. Well, that worked really well. But Trump's not crazy, right? He knows that he's walking a fine line. So at some point, he will have to make that pivot. So we made that already in our previous case as well. At some point, he will have to say, okay, enough is enough. I don't want to have a recession on my term. So he's only one term left, Rob, so he can get reelected. So
Rob,
now or never.
Rob, let's get. He doesn't have to pivot until November, because he's going to have a new Fed next year, a new chairman. That's his choice, and maybe one or two new governors. And then, if the economy's weaker, he's going to be able to cut rates. And you're going to potentially have tax cuts. The one thing that I'm bothered by is that the spending right now is $7 trillion, right? Tax receipts are close to 5. So I'm ballpark, $7 trillion of spending, tax receipts 5, interest on the debt is 1. So 751. $7 trillion of spending, 5 trillion of tax receipts, and 1 trillion of interest costs. And so right now we're up close to 20% of our tax receipts are going to interest, whereas Germany's like 2%, France is maybe 3 or 4, and the UK is in that. So the rest of the developed world, in terms of tax receipts, as a percentage of interest as a percentage of tax receipts, we're approaching 20%, and the rest of the developed world is anywhere between 1 to 4%. Isn't that what gold and hard assets are trying to tell us?
Well, yeah, of course. The way to get out of this mountain of debt. And by the way, everybody always talks about debt, but this is also true for Europe, of course. But the unfunded liabilities are 3, 4, 5 times higher than the debts. It's like unfunded liabilities in the United States are 180 trillion right now.
Now, Rob, so when you talk about spending, so just this morning, the German legislature passed the budget. So one of the things we talked about 2 weeks ago on this show is that the rest of the world is in a fiscal expansion mode. So Germany just increased their spending by probably the most in decades. It was approved by the legislature this morning. So you're in a fiscal expansion in Europe, fiscal expansion in China, and a fiscal contraction in the United States. That is a big, big shift compared to where we were the last 4 years. And is that why capital is flying out of the United States into global value, into global equities, into emerging markets, into MSCI World ex-US? I mean, this capital flow is like right now, the NASDAQ 100 is law. It was 27 trillion on February 20th, 27 trillion. Now we're just below 24 trillion. So it's lost 3 trillion of value. Where has that money gone? Gold miners, international equities. What's happening here, Rob? What are you hearing in the chat?
Yeah, there's a rotation that happened in the beginning of January from international. But let's not forget one thing, that rotation, well, I would say, I mean, the US has outperformed the rest of the world like for the last number of years. But then you had I'd say an acceleration of that outperformance after Trump won. We're back to just about the ratio where it was just before he won. This whole idea that, oh, Trump is going to like further this American exceptionalism. He is going to boost growth even more. That story, that was essentially fostered by Trump 1.0, and people played into it. They threw that out the window. They threw that out the window because by Trump 1.0, he started with the tax cuts and then he did the tariffs. First, he wanted the U.S. to grow, and then he said, and then the strategy is okay, then we'll hit them with tariffs, and then the economy can absorb that. Right now, he's saying, I'm going to hit these tariffs first, and then we'll do the tax cuts. So the problem is that is on paper is a great story, but the the tariffs are all the purview of the White House, the executive, whereas the tax cuts are now stuck in Congress, and we don't know how long they're going to be stuck for. Now, we do know that the government is actually running out of money sometime by the end of July, the beginning of August. So then we call that the X date, right? So they're under the ceiling, but Treasury Secretary Bessent has a big pool of money, cash, with which he can pay the bills right now. On the 15th of April, he gets a lot more cash in because that's where everybody pays their taxes or whatever they are due above and beyond they already paid. So that will give him time until late July to pay all the bills, at which point he starts to default. So that's a pressure point on Congress to act before the end of July. But until then, we could be sitting under this debt ceiling and nothing is happening on the legislative side.
And let's pull up that chart with the CDS of the United States. Sorry, Rob, go ahead. Go back to what you said.
So you need to, in order to offset the malaise that is over the market right now, the worries about the collapse in earnings growth, all these companies warning, you need to get the tax cuts going, right? Which will offset this whole tariff headwind. But Congress is not doing anything right now. In fact, they're in recess. They're on vacation.
Yeah. But yeah, so the U.S., the credit default swaps, the CDS on the United States, I'm waiting for that chart. But, that's been showing us a big, big rise in the cost of default protection. And I think what Dalio's getting at is later in the year, what you're getting at is we're going to have to catch up. There's a potential fiscal cliff. And all that means is Biden spent so much money, and then we have this reconciliation bill. And then we find out, okay, what are they going to do about the debt ceiling? And then once they can, then all of a sudden they're going to have to catch up a tremendous amount of debt issuance, in, I guess, maybe it's like August, September, October, November. And so that's where you get that big, big debt issuance. Rob, on this reconciliation bill, It's in the House, went from the House to the Senate.